If you're serious about trading, the hardest part isn't riding a trend. The hardest part is knowing when that trend is about to flip. Because the market doesn't send you a memo. It turns quietly, it breaks structure, and by the time most people realize what happened, they're already chasing the move. That's why today we're looking at an open source indicator called Pivot Trend by ChartPrime. This tool is built for one job: help you spot real trend reversals based on market structure pivots, not laggy smoothing like a moving average. It's designed to show you when sentiment shifts, when structure breaks, and where the new trend line sits so you can plan cleaner entries instead of buying tops or shorting bottoms. We're going to set it up on TradingView, which is the platform I'm using. If you haven't signed up and you want to follow the exact setup, there's a link in the description. Open TradingView, pull up AUD/NZD, and choose a time frame that fits your style. For this walkthrough, I'm using the 1-hour chart so you can clearly see the swings and the retests. Now click Indicators, search Pivot Trend by ChartPrime, and add it to the chart. Once it loads, you'll immediately notice two things: a trend line that shifts color and position, and the buy and sell markers that show up when the trend flips. Here's what makes this indicator different. Most trend tools rely on averaging price, which means they lag and they can get fooled by sharp spikes. Pivot Trend takes a structure-based approach. It looks for pivot points, meaning real turning points where price formed a swing high or a swing low. It does that by scanning the highest highs and lowest lows inside a window you control, then using those pivots to map trend direction. So on the chart, the line is your trend guide. When the line is blue, it's telling you the structure is bullish and the trend is up. When it's red, structure is bearish and the trend is down. In a bullish trend, the line sits below price and acts like dynamic support. In a bearish trend, it sits above price and acts like dynamic resistance. That's why this tool is so useful for entries. Instead of guessing where support or resistance is, you get a trailing structural level that updates as the market builds new pivots. You'll also see the signal markers. When the trend flips bullish, you'll get a clear buy marker on the chart. When it flips bearish, you'll get a sell marker. Think of those as the alert that structure just changed. But the real edge isn't blindly buying the moment you see a buy marker. The real edge is using that new trend line as your retest level, so you enter after the market confirms the flip instead of chasing the first candle. Before we get into the strategy, let's quickly go through the settings, because this is where you control what market structure means for you. The first input is left bars. This is the number of candles to the left of a pivot that must be lower or higher for that pivot to count. In simple terms, if you want a swing high pivot, the pivot candle has to be higher than the candles to its left. The second input is right bars. This does the same thing on the right side. The pivot candle must also stay the highest or lowest compared to the candles that come after it. That's important because it forces confirmation. It stops the indicator from calling every tiny wiggle a pivot. So if you set left bars and right bars to 10, the indicator will only mark a pivot if that candle is the highest high or lowest low across a 21 candle window, 10 candles before it, 10 candles after it, plus the pivot candle itself. Bigger values mean fewer pivots and smoother signals. Smaller values mean more pivots and faster signals. The third input is offset. This is basically your sensitivity filter. If you're trading something volatile or you're on a lower time frame, pivots can trigger too often. Offset helps filter that out by demanding a more meaningful swing before a pivot is accepted. Higher offset means stricter pivots and fewer signals. Lower offset means more sensitivity and more signals. So here's how you choose settings without overthinking it. If you're a swing trader who wants major structural turns, raise left bars and right bars. You'll get fewer flips, but they'll be more important. If you're a scalper or short-term trader, lower them so the line reacts quicker and you get tighter structure levels for fast trades. Then use offset to calm the tool down if it's firing too many pivots for your market. Now let's talk about the strategy this indicator is best at: trading the retest. When the market flips, the first signal is often the worst entry because that's the moment everyone feels FOMO. Pivot Trend solves that by giving you a dynamic support or resistance line that trails with the new structure. Your job is simple: don't chase the first move. Wait for price to come back and retest that line, then enter when it holds. Here's the long setup on AUD/NZD. First, you want to see the trend flip bullish. That means the line turns blue and you get the buy marker. This tells you structure has shifted and the market is attempting to start a new uptrend. Second, you wait. Do not buy immediately. Let price move away and establish the uptrend. The clean setup usually comes after the first pullback. Third, you watch for price to pull back into the blue line, because in an uptrend, that blue line is dynamic support. This is the floor that needs to hold if the trend is real. Fourth, once price touches the line or gets close to it, you wait for a clear bounce. The simplest confirmation is a bullish engulfing candle, or at least a strong bullish candle that rejects the line and closes back up. That's your entry trigger. For risk management, your stop loss goes below the line and below the swing low created during the pullback. You want it placed where the trade is clearly wrong if price breaks through. For take profit, you can keep it simple and target 1.5 times your risk, or aim for the next major structure level to the left. If the trend stays blue and price keeps respecting that line, you can trail your stop under the line as it rises. Now the short setup is the exact mirror. First, the trend flips bearish, the line turns red and you get the sell marker. This tells you structure has shifted and the market is starting a downtrend. Second, you wait for the first move down to happen. Again, you don't want to short the very first breakdown candle. Third, you wait for a pullback back up towards the red line. In a downtrend, at red line is dynamic resistance. It's the ceiling bulls need to break, and if they can't, the downtrend stays valid. Fourth, when price tops the red line or gets close, you wait for rejection. A bearish engulfing candle is ideal, or a strong bearish candle that closes away from the line. That's your entry trigger. Your stop loss goes above the line and above the pullback swing high. Your take profit can again be 1.5R or the next major support level to the left. And if the trend stays red and price keeps respecting that line, you can trail the stop above the line as it steps down. That's the core reason traders like this tool. It turns market structure into something you can see and repeat. You're not trying to predict reversals with a lagging average. You're watching price break structure. You're letting the indicator map the new structural boundary, and you're entering on the retest instead of the impulse. One more important rule. This is a confirmation tool, not a standalone system. The buy and sell markers are not meant to be taken blindly. Use them with context. Check nearby support and resistance. Check the broader trend on a higher time frame. Use volume or momentum if that's part of your system. The indicator gives you the structure shift, but you still want extra confirmation before risking money. And that brings us to the final thought. If pivots are the purest expression of structure, what happens when a major news event hits and blows through weeks of clean technical levels? In those moments, structure can get invalidated fast. So as a structure-based trader, your job is to respect the line, but also respect reality. When volatility spikes and fundamentals take over, don't treat any indicator like a guarantee. Use it as a guide, manage your risk, and stay flexible. This is not financial advice. Everything here is for education only. Always trade with a plan, use proper risk management, and test this approach on AUD and ZD before going live. If you found value in this video, leave a like and consider subscribing for more indicator breakdowns and clean trading strategies. Thanks for watching. See you next time.